When a downtrend is about to roll over, it often prints one very specific shape, an inverse head and shoulders. Three lows, a left shoulder, a deeper head, and a higher right shoulder, sitting beneath a neckline that connects the peaks between them. It's the mirror image of the most famous top in trading, and it's how some of the cleanest reversals begin. Today we'll trade it with discipline, the anatomy, the trigger, the measured move target, and the mistake that gets people long way too early. Here is the anatomy you have to see clearly before anything else. After a downtrend, price prints a low, the left shoulder. It bounces, fails, then makes a lower low. That's the head, the deepest point of the pattern. From there it rallies again, then sells off but stops short of the head, making a higher low, the right shoulder. Connect the peaks of the two intermediate rallies and you have the neckline. That higher right shoulder is what tells you sellers are losing control. Each successive low is shallower, which is the structural opposite of a healthy downtrend. Here's the key insight beginners miss. Spotting the shape is half the trade. The other half is the trigger, the neckline break, and without it, you have nothing actionable. A textbook perfect inverse head and shoulders that never breaks the neckline is just a pretty chart that did nothing. The shape is the setup, the break is the trade. Now the trade. You enter long on the close above the neckline, not on an intraday wick that pokes through and reverses, but a confirmed close, ideally on a volume surge. Your stop goes just below the right shoulder because a push back through it means buyers haven't actually taken over and the pattern has failed. Your target is the measured move. Take the height from the head up to the neckline and project that same distance above the breakout. That's a defined entry, a logical stop, and a math-based target, everything a setup should have. Now the trap, because the right shoulder looks so tempting. Price has held above the head, you're convinced the reversal is coming, you want a tighter entry, so you buy at the right shoulder. You're buying anticipation, not confirmation. If the neckline never breaks, your trade is a loss in a continuation. Even worse, the head can be retested and broken before any reversal materializes. Wait for the actual trigger every single time. The discipline of waiting for confirmation is what separates traders with edge from traders with hope. On a real chart, scroll through any volatile name and you'll find these forming at major lows. The ones that worked all share the same fingerprint, a clear higher right shoulder, a clean neckline break on volume, and a measured move that played out to within a few percent of the projection. The ones that failed broke down through the head before the neckline ever broke. Train your eye to demand the right shoulder and the close above the neckline before you commit a cent, and the pattern starts paying you reliably. So, an inverse head and shoulders is three lows with a higher right shoulder, capped by a neckline. You enter on the close above the neckline, stop below the right shoulder, and target the measured move. Don't anticipate the pattern by buying the shoulder, wait for the actual break. Done with discipline, it's one of the cleanest reversal setups in the playbook. Subscribe for the full method and trade your own plan. Education, not financial advice.